money setup. Now let's proceed with the fourth filter, volume indicator. The volume indicator is usually displayed as vertical green and red bars at the bottom of the chart. Each bar shows the total trading volume executed during a specific candle period. It's important to understand that volume measures trading activity, not momentum directly. Green bars usually appear when a candle closes above its open, showing bullish volume. Red bars usually appear when a candle closes below its open, showing bearish volume. When volume increases during an uptrend, it confirms strong buyer participation and supports continuation. But when volume starts decreasing during an uptrend, it may show that buyers are losing strength, which can lead to a pause, pullback, or even a shift in market structure. The same idea applies in a downtrend. Rising volume during a downtrend confirms strong selling pressure and supports bearish continuation. But falling volume during a downtrend may show that sellers are weakening, which can lead to a pullback, consolidation, or even a potential bullish shift. So in simple terms, rising volume confirms the move. Falling volume warns that the move may be losing strength. Now you might ask, how can we use this indicator to improve our trades? As you know, order blocks are considered decisional areas where institutional orders may have entered the market before a strong move happened. Because of this, price is often expected to react when it returns to these areas. This is where volume can help. When we see an unusual increase in volume around a supply or demand zone, it adds more confirmation that strong orders were likely executed there. In other words, high volume inside or near an order block can support the idea that smart money was involved in that move. So, before entering a trade, volume can be used as an extra confluence factor. If price creates a strong order block with a clear volume spike and later returns to that same zone, there is a higher chance that price may respect it and react from that area. The second key way we use the volume indicator is by spotting volume divergence as a strong reversal signal. In a bullish move, if price keeps rising but volume bars start getting smaller, it means buyers may be losing strength. Even though price is still moving upward, the buying pressure is not supporting the move anymore. This is called bearish volume divergence, and it can signal a potential pause, pullback, or reversal to the downside. The same applies in a bearish move. If price keeps falling but volume bars start decreasing, it means sellers may be losing strength. Even though price is still moving downward, the selling pressure is weakening. This is called bullish volume divergence, and it can signal a potential pause, pullback, or reversal to the upside. Volume divergence can add extra validation and confirmation to our setup, especially when price is reacting from an important zone. To properly read the volume indicator without being confused and with ease, all we have to do is, when the price reaches a key zone on the chart, look for spikes forming in the volume indicator, confirming that divergence has occurred. This gives us the confluence we need to use as extra confirmation to place entries. For example, here on the Bitcoin Tether 1-hour chart, price is clearly in a strong downtrend and has already created bearish breaks of structure. Then price pushes upward, sweeps the buy-side liquidity above a key swing high, and taps into this 1-hour fair value gap. After filling the FVG, price reacts from it and shows rejection. Now, if we check the volume indicator, we can see that as price continued moving upward toward the FVG, the volume bars started getting smaller. This tells us that even though price was pushing higher, buying pressure was weakening. That creates bearish volume divergence. In simple words, price is moving up, but volume is not supporting that move. This gives us an early sign that the upward move may be losing strength and that a pause or reversal to the downside could happen. So now, we have the extra confirmation we were looking for. Price swept buy-side liquidity, tapped into a key 1-hour fair value gap, showed rejection, and volume confirmed that buying pressure was decreasing. If you look more closely at the volume indicator, you can also notice a clear volume spike near the reaction area. This spike shows that selling pressure started to enter the market, adding even more confirmation that a bearish reversal may be forming. With these confirmations in place, you can either use a single time frame entry or zoom into a lower time frame and wait for a market structure shift, change of character, or your entry model to open a short position. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did,